Before anyone even glanced at a chart, the tone of the silver market had already shifted. You could feel it in the way normally quiet institutions started clearing their throats, adjusting policies, and without much fanfare stepping slightly out of rhythm. This wasn't about a dramatic price spike flashing across screens, or the usual daily noise traders love to argue about. It was about behavior. And when behavior changes at the institutional level, that's usually worth paying attention to. What unfolded over the last several days didn't arrive with sirens or bold headlines. It arrived disguised as routine. A short notice, easily overlooked, stated that sales of certain silver products were being temporarily suspended while pricing was reviewed due to changing metal costs. On paper, that reads like standard operational housekeeping. Systems update, spreadsheets catch up, and business review maze. Anyone who's watched commodity markets for a while has seen this movie before. But context matters, and the backdrop here was anything but ordinary. Silver prices were moving faster than they had in recent memory, and physical premiums were already stretched across multiple retail channels. When a manufacturer-distributor hybrid like the United States Mint pauses sales, the wording of the announcement matters less than the conditions that made the pause necessary in the first place. The Mint isn't a speculative trader. It doesn't chase momentum or gamble on timing. It buys metal through established channels, turns that metal into standardized products, and sells them using a markup structure designed to handle normal price fluctuations. This system has survived inflationary periods, deflationary scares, commodity booms, and financial crises. It's built for stability, not agility. So when that system hesitates, even briefly, it suggests price movement pushed beyond the tolerances baked into the process. One explanation is procedural. Pricing models can lag fast markets, and a temporary pause gives administrators time to recalibrate. That's reasonable and consistent with past episodes. Another explanation is more structural and revolves around replacement risk. Selling inventory during a sharp move isn't just about the price you sell at. It's about whether you can replace that inventory without taking losses or facing delays. In physical commodity markets, replacement cost isn't a footnote, it's the main event. If metal prices rise quickly and suppliers can't guarantee timely restocking at comparable terms, pausing sales becomes a rational risk management decision. That doesn't mean silver vanished overnight. It means the friction in the supply chain increased enough to make business as usual temporarily impractical. Think of it less as scarcity and more as resistance in the system. At the same time, retail premiums were already telling their own story. Dealer listings showed a growing gap between futures prices and what buyers actually had to pay for physical products. These premiums weren't screaming panic, they were signaling caution. Dealers were protecting themselves against near-term replenishment uncertainty. Premium expansion often fades as markets normalize, but it can linger if upstream conditions stay tight. To be fair, government mints have paused sales before for reasons that had nothing to do with supply stress. Production schedules, contract reviews, inventory audits, all perfectly mundane explanations. Without internal data, it's impossible to assign intent or severity beyond what's publicly stated. The pause itself isn't the headline, its timing is. While that was unfolding, something else was happening quietly inside major depository systems. Daily reports from exchange-approved vaults showed net withdrawals of physical silver during the same window. Inventory moves happen all the time, and most of them are boring. But when withdrawals occur across multiple vaults at once and exceed typical ranges, they deserve a closer look. In this case, reported figures showed over 1 million ounces leaving vaults in a single session. This wasn't metal being shuffled between accounting categories. It physically exited storage facilities, implying transportation rather than paperwork. And while we don't know who withdrew it, the scale points to institutional activity, not someone backing a pickup truck up to a loading dock. Again, there are multiple explanations. Deliveries against futures contracts, industrial usage, or relocation to private storage all fit the data. None of these imply market failure. What stood out was where much of the metal came from. A significant portion was withdrawn from inventory classified as eligible rather than registered. That distinction matters. Registered silver is earmarked for delivery against futures contracts and moves regularly as part of settlement. Eligible silver, on the other hand, is privately owned metal stored in exchange-approved vaults, but not committed to delivery. Owners pay to keep it there because it's convenient. Historically, eligible inventories are relatively stable. When they decline sharply, it suggests owners are making a deliberate choice to move their metal. Those choices can be driven by many factors: counterparty considerations, changes in storage strategy, or shifts in geographic demand. No conspiracy required. But each withdrawal reduces the pool of metal readily accessible within the exchange system, and that changes the math for everyone else. Layer onto that the price differentials showing up across regions. During the same period, Reported physical prices in parts of Asia were consistently higher than Western futures prices, even after factoring in transportation and financing. Regional spreads aren't unusual, but when they widen beyond typical arbitrage bands, they encourage physical movement of metal toward higher-priced markets. This kind of arbitrage isn't speculative bravado. It's mechanical. If metal can be bought in one market and sold elsewhere for a higher net price, participants will do it until the spread narrows. That equalization normally happens through volume. But if exchange inventories are shrinking while external demand stays firm, the adjustment mechanism shifts. Volume can't do the job alone, so price has to step in. That doesn't predict where prices are headed. It simply describes how arbitrage equilibria function when supply is constrained. Futures prices must rise enough to slow out flows or attract metal back into storage. It's less drama, more plumbing. Downstream, the retail market feels these shifts almost immediately. Wholesalers facing higher replacement costs widen premiums and manage availability more conservatively. Government mints, private dealers, and fabricators are all reacting to the same inputs, just with different constraints and tolerances. Of course, markets have cried wolf before. Inventory drawdowns have reversed. Regional spreads have closed. Sales suspensions have been lifted with no lasting impact. Markets are adaptive, and apparent stress can evaporate as quickly as it appears. What makes this moment interesting isn't any single data point. It's the simultaneity. Elevated volatility, expanding premiums, institutional inventory withdrawals, and official sales pauses all occurring within a compressed time frame. Individually, they're unremarkable. Together, they form a pattern worth studying, not sensationalizing. Another layer often missed is demand composition. Industrial consumption, especially in energy and electronics, doesn't care much about investor sentiment. If industrial buyers keep procuring silver despite rising prices, they establish a baseline level of physical demand that doesn't show up clearly in futures positioning, that can amplify investment-driven flows without flashing warning lights on standard indicators. Investment demand, on the other hand, is fickle. It responds quickly to changes in momentum, interest rates, currency movements, and regulatory signals. Any serious assessment of current conditions has to remain flexible, recognizing that today's behaviors are based on assumptions that can change. The sales pause, inventory movements, and price differentials don't define an outcome. They define a moment, a point where participants are reassessing exposure, replacement risk, and custody preferences. Whether this resolves through higher prices, replenished inventories, or softer demand depends on variables still in motion. What is observable is that physical silver, distinct from paper representations, has moved closer to the center of decision-making. When physical considerations shift from background noise to foreground input, market mechanics change in subtle but meaningful ways. Small changes in availability or demand start producing outsized behavioral responses, feeding back into pricing and inventory decisions. One practical way to frame what's happening is to separate convenience from control. Exchange-approved vaults offer standardization, transparency, and easy transferability, great features when liquidity is the priority. But when uncertainty rises around replacement cost, delivery timing, or regional price alignment, the value of convenience can shrink relative to the value of control. Control doesn't mean panic or distrust. It means reducing dependencies between ownership and access. For institutions treating silver as an input or strategic reserve rather than a trading chip, custody preferences can change quickly when spreads widen and inventory trends point the same way. The metal is the asset. Storage is just the interface. This is where the eligible versus registered distinction stops being a technical footnote and starts signaling agency. Registered inventory moves because it has to. Eligible inventory moves because someone decided it should. That choice doesn't break the system, but it does make it less predictable. And when predictability fades, markets don't collapse. They recalibrate. Quietly, methodically, and usually before the headlines catch up. What tends to get overlooked in discussions about inventory is that not all movement is created equal. Scheduled deliveries, contract settlements, and routine logistics can be modeled with reasonable accuracy. They're nosy, but they're familiar. What's far more difficult to anticipate are discretionary withdrawals by long-term holders. Those decisions aren't driven by calendars or formulas. They're driven by judgment calls about opportunity cost, storage risk, counterparty exposure, and what else that metal could be doing instead of sitting quietly in a vault. When even a modest portion of eligible holders start thinking along those lines, the character of exchange inventory changes. It becomes less of a static buffer and more of a living reflection of shifting preferences. That's why it's important not to overreact to any single day's data. Inventory reports are famously lumpy. Withdrawals and deposits often arrive in batches, shaped by shipping schedules, reporting cutoffs, and plain old logistics. A large outflow one day can be followed by an equally unremarkable inflow the next, leaving analysts who jump too early explaining why the sky didn't fall. The real signal emerges not from one print, but from repetition. When declines persist across multiple reporting periods, when they cluster in particular vaults or inventory categories, the conversation shifts. At that point, it stops being about an isolated event and starts looking like a sustained change in behavior. Another question that deserves more careful treatment is the destination question. Physical metal doesn't disappear. It moves. Yet public commentary often talks about outflows as if silver is being swallowed by a black hole. In reality, it usually ends up in one of a few places. It can move into industrial supply chains where it's consumed and, at least in the short run, effectively gone. It can be relocated into private vaulting systems, still very much above ground, but outside exchange infrastructure. It can be shifted into sovereign or quasi-sovereign reserves, or it can flow into regional markets where the all-in price is higher. Each of these destinations has different implications for persistence. Industrial consumption is sticky. Once silver is embedded in a product, it's not coming back anytime soon. Private vaulting is more reversible. If incentives change, that metal can re-enter more liquid channels. Regional arbitrage flows can reverse if price spreads narrow or local demand cools. This is why regional pricing differentials matter so much. They act like gravity. They don't guarantee movement, because movement requires financing, insurance, transport, regulatory clearance, and access to the right bar specifications. But the wider the differential, the more willing participants become to overcome those frictions. Even relatively modest spreads can be meaningful once you measure them against the cost of carry. For anyone actually executing these trades, the calculation is not as simple as buy here, sell there. It's buy, finance the position, insure it, transport it, wait, manage price risk along the way, and then sell. If, after all of that, the premium still makes sense, it tells you something important. Either local demand is strong enough to absorb higher prices without blinking, or local supply is constrained enough that buyers are paying up for immediacy. Sometimes it's both. Of course, there are legitimate counter-arguments that strengthen rather than weaken the analysis. Not every price, quote, is apples to apples. Futures prices reflect standardized deliverable forms, locations, and settlement dates. Physical market prices can reflect different bar sizes, assay standards, delivery terms, or local tax regimes. Some portion of any spread can be structural rather than stress-related. That nuance matters. But even after adjusting for those factors, large and persistent differentials still influence behavior. If buyers in one region consistently pay more on an all-in basis, sellers elsewhere notice. Over time, the market tries to reconcile that difference. That reconciliation can happen in a few ways. Supply can flow toward the higher-priced region, demand there can ease as prices rise, or the benchmark price used elsewhere can move higher. Which channel dominates depends on elasticity. And silver is a peculiar mix. Short-term supply is relatively inelastic. Mines don't ramp up output because of a good week on the chart. Refining capacity has limits. Recycling does respond to higher prices, but with a lag that's measured in months, not days. Demand is split. Investment demand can be fickle and sentiment-driven. Industrial demand is often less elastic because silver performs functions that aren't easily substituted without cost or performance trade-offs. When you combine that structure with higher volatility, institutions tend to narrow their exposure to operational risk. This isn't an emotional reaction, it's mechanical. Dealers adjust inventory policies. Fabricators tweak product lines or extend lead times. Mints pause certain offerings until procurement contracts catch up with reality. Large holders rethink where and how they store metal. Each decision makes sense in isolation. What becomes interesting is how they interact. A mint pause can tighten retail availability, pushing premiums higher. Higher premiums can attract, scrap supply, and encourage some holders to sell, easing tightness. But higher premiums can also stimulate demand by signaling scarcity, which can do the opposite. If, at the same time, large withdrawals continue from exchange vaults, the pool of metal available for rapid delivery shrinks. That can widen spreads further, reinforcing the incentive for additional withdrawals. This is the feedback loop at the heart of the system. Price influences behavior. Behavior reshapes inventory. Inventory feeds back into price. Within that loop, the paper versus physical debate is best understood as a question of timing, not trust. Futures markets price a promise of delivery under defined conditions. Physical markets price metal that can be obtained under current logistical constraints. In calm conditions, arbitrage keeps those prices closely aligned. When stress rises, the arbitrage mechanism still exists, but it works with more friction and wider tolerances. If friction increases enough, paper prices can lag physical prices, or in other circumstances, overshoot them. During rapid liquidation events, futures can fall faster because paper can be sold instantly. Physical prices may hold up because metal doesn't move as quickly. During periods of urgent procurement, the opposite can happen. Physical prices rise relative to futures because immediate availability matters more than a standardized promise weeks out. Neither scenario implies deception or failure. It simply means that liquidity and deliverability are being priced differently. That brings us to capacity. How much physical metal can actually move through the system quickly enough to satisfy demand at prevailing prices? Headline inventory numbers don't answer that question. Reported inventories include metal that is owned by parties who may have no intention of selling at current levels. Accessibility depends on willingness, contract terms, location, and form. A large inventory figure can coexist with tight conditions if owners are unwilling to part with metal or if it doesn't meet delivery specifications. Conversely, smaller inventories can be sufficient if demand is light and supply flows smoothly. Turnover is the key variable. How much metal is changing hands, how quickly, and at what prices? Sudden institutional withdrawals matter because they can reduce turnover within exchange ecosystems. The metal still exists, but if it migrates from systems designed for high transferability into systems optimized for custody and long-term holding, the market's ability to respond to demand spikes becomes less flexible. Narrower pathways don't eliminate supply, they raise the price required to mobilize it. From a pricing perspective, that reduced flexibility can amplify moves. Small changes in demand require larger price adjustments to elicit supply. It can look like volatility driven by emotion, when in reality it's microstructure doing the heavy lifting. The market isn't just discovering what silver is worth in abstract terms. It's discovering what immediate deliverability is worth under a particular configuration of inventories, logistics, and risk preferences. Layered on top of all this is the macro environment. Currency strength, real interest rates, and broader risk sentiment can amplify or mute physical signals. Rising real yields tend to pressure non-yielding assets. Currency weakness or financial stress can revive safe haven demand. Macro-driven flows can widen or compress spreads temporarily in ways that later reverse. That's why it's dangerous to attribute every inventory move directly to physical stress. These are interacting systems, not single-cause narratives. The most useful analytical approach is consistency. Do retail premiums stay elevated after the initial excitement fades? Do eligible inventories continue to decline over multiple sessions? Do regional premiums persist after adjusting for known structural costs? If the answer is yes across several indicators, the probability rises that the market is repricing deliverability risk rather than reacting to a fleeting sentiment swing. If inventories stabilize, premiums soften, and spreads narrow, the episode may resolve as a volatility-driven dislocation that the system absorbs. In that sense, the current environment is less a verdict than a diagnostic window. The market is revealing where constraints might exist, not declaring that they must become permanent. What matters is how participants behave when incentives shift again, when prices move high enough to draw out supply, when contracts reset, when procurement cycles roll forward, when holders reassess whether custody and control still outweigh liquidity and ease of transfer. The more consequential question isn't whether any single institution paused sales. It's whether the broader incentive structure now encourages metal to remain outside the most liquid venues for longer than it historically has. That's the condition under which even routine demand surges can produce outsized price responses, especially when arbitrage pathways are constrained by timing, form, and the willingness of holders to convert inventory into flow. That distinction becomes critical when thinking about how markets transition from adjustment to stabilization. A system under strain doesn't necessarily fail. More often, it reconfigures. Prices rise to levels that coax metal back into circulation. Logistics adapt to capture arbitrage opportunities. Demand moderates as costs rise. These mechanisms are always present. The question is how quickly and smoothly they operate when multiple constraints interact. Substitution is one constraint that deserves careful attention. In many industrial uses, silver isn't prized because it's shiny or traditional, but because it works. Conductivity, reflectivity, durability, these properties matter. Substitutes exist in some applications, but often at higher cost or lower performance. When prices rise sharply, manufacturers revisit designs, reduce loadings, or explore alternatives. But those changes take time. They play out over quarters, not days. In the meantime, demand can remain firm even as prices move. Eventual higher prices do ration demand. Marginal uses are deferred. Inventory buffers are drawn down. Recycling becomes more attractive. These responses are slow but real, and they're why commodity markets rarely move in straight lines forever. Rapid repricing phases are often followed by consolidation as the system absorbs new information. Transparency is another stabilizer. As volatility eases, data quality improves. Backlogs clear, delivery schedules normalize. Reporting catches up with reality. What initially looks like a sharp structural break can, in hindsight, resolve into a meaningful but manageable regime shift rather than a crisis. Counter scenarios are essential here. One plausible explanation for recent dynamics is timing. Inventory withdrawals clustered around contract cycles or fiscal transitions can exaggerate short-term signals. Metal that exits exchange vaults might reappear in private storage, and later return if pricing and custody terms improve. A mint suspension can end quietly once procurement contracts reset, leaving little lasting impact. Regional differentials can also close without drama. Physical premiums can retreat if buyers step back at higher prices or if supply chains adapt. Futures prices can consolidate or pull back as speculative positions unwind. Either path reduces arbitrage pressure without requiring anything dramatic. Macro conditions add further uncertainty. Shifts in interest rate expectations, currency movements, or risk appetite can redirect capital flows quickly. A stronger currency or higher real yields can dampen investment demand even if physical conditions remain somewhat tight. Renewed stress elsewhere can reignite demand regardless of near-term supply adjustments. These cross-currents mean no single factor should be treated as decisive on its own. From an analytical standpoint, the most telling signals are the ones that persist after the initial reaction fades. Do inventories stabilize or keep trending? Do premiums compress or stay wide? Do regional spreads close through convergence or through reduced activity? Each outcome points to a different resolution. Stabilizing inventories with elevated prices suggests repricing has done its job. Continued inventory decline alongside rising prices suggests non-price consideration, like custody preference, are dominating. A quick rebound points toward timing and volatility rather than structural tightness. Behavior at the margins often gives early clues. Smaller dealers and secondary markets tend to feel easing conditions first. Shorter delivery times, narrower bid-ask spreads, and more consistent availability can signal normalization before benchmarks move. Persistent delays in rationing can indicate adjustments are still incomplete. Throughout all of this, narrative discipline matters. Markets are complex adaptive systems. They don't move because one vault reports a withdrawal or one institution pauses sales. They move because countless participants respond to shifting incentives and constraints. Any story that treats one outcome as inevitable risks missing the moment conditions change. What can be said with confidence is that recent developments have highlighted how sensitive the silver market can be to physical availability, custody preferences, and regional demand. They've reminded participants that price isn't just a number on a screen. It's a coordination mechanism that has to reconcile paper promises with physical reality over time. When that alignment weakens, even briefly, behavior adjusts in ways that amplify signals. Whether those signals fade or harden into a longer-term regime depends on how quickly alignment is restored. Restoration can come through higher prices, operational adaptation, or demand responses. None of those paths require dramatic language. They're the ordinary mechanics of market adjustment playing out under less than ordinary conditions. The most productive posture, especially now, is observational rather than declarative. Watch how incentives shift. Watch how quickly frictions ease or persist. Watch how participants recalibrate. The silver market has navigated tightness before, and each episode resolved differently because each had a different configuration of supply, demand, and macro context. In that sense, this moment is best viewed as a test of flexibility. How flexible are supply chains when prices move? How flexible are holders when custody preferences change? How flexible are benchmarks when regional realities diverge? The answers don't arrive with headlines. They emerge gradually, often in quieter periods when volatility slows and the market reveals whether it has absorbed the shock by restoring flow, or whether it continues to operate with narrower channels that keep deliverability at a premium relative to paper representations as participants weigh liquidity, control, and opportunity cost in an environment that is still adjusting rather than settled.